Welcome to the Learn English Lab. Today's podcast, English vocabulary listening practice topic name is 30 plus C1 level vocabulary economy. We are diving headfirst into the language of, well, high finance and global markets. Because let's face it, if you want the analytical shortcuts to sounding truly well-informed about the global economy, you really need the right verbal toolbox and not just the basics.
That is absolutely the truth. For any professional or student aiming for C1 proficiency, or really anyone engaging in serious discussions about international business or public policy, well, grasping this advanced economic vocabulary is essential. It moves you past just vague terminology. It lets you articulate precisely why an economy might be facing a stagnant economy that's rooted in, say, a systemic credit crunch, rather than just saying things are slow.
It truly is an investment, isn't it? An investment in your linguistic skills. So, our mission today is pretty sophisticated. We're not just going to memorize over 30 complex terms. No. We are decoding this entire financial lexicon, bridging the theory with nuanced real-world application, and making sure you possess the precise language necessary to contribute meaningfully, whether it's complex policy debates, detailed business analyses, or just understanding high-level economic reports.
Exactly. We have to place these concepts into rigorous context. We need to understand not just the definition, but the mechanisms of how they operate, their impact, and their implications. Our goal here is really to empower you to discuss complex systems, things like market dynamics, fiscal challenges, international trade disputes with genuine precision, and, importantly, insight.
Okay, let's do it. Let's unpack this financial lexicon. We're starting with the biggest possible picture. How do world leaders and economists even begin to measure the financial health of an entire nation? That requires indicators and cycles, the sort of diagnostics of the macroeconomy. So the most fundamental measure, I suppose, of a country's productive power is aggregate output. This term refers to the comprehensive sum of all goods and services that an economy produces over a defined period, usually a year.
It really is the metric that defines the scale of a nation's activity. And when you analyze it in time series, looking at changes from one year to the next, aggregate output is the clearest way to track growth or contraction. When this total production increases, it's a really powerful signal to the market, to policymakers, that the economy is indeed entering, hopefully, a recovery phase.
And this is exactly why policymakers pay such keen attention to this number, right? If they decide the economy needs a boost, their stimulus strategies, whether it's infrastructure investments or tax breaks, they're all aimed directly at boosting that total output, trying to create a multiplier effect throughout the system.
Agreed. And while aggregate output gives you that overall health reading, often economists need to be far more specific about who is generating that value. And that brings us to the crucial distinction between GDP and GNP.
The famous border argument.
Right. So gross domestic product, or GDP, is defined by location. It's the total monetary value of all goods and services produced within a country's geographic borders. Crucially, it includes output from foreign-owned companies operating domestically.
Whereas gross national product, GNP, takes the resident approach. It's the total value produced by a country's residents, regardless of where they are physically located. This is the key difference. GNP includes net income earned by citizens and corporations from assets held or work performed abroad. And then you subtract the income paid out to foreigners operating domestically. This distinction is incredibly important for policy analysis, particularly for you, the listener, to grasp. For countries like the United States or China, which have, vast domestic production capacity, GDP is usually the main focus. But for countries with large populations of citizens working overseas, think the Philippines, or maybe certain European nations where remittances are a huge part of national income, GNP, often serves as a more accurate gauge. It better reflects the national welfare and wealth generated by its populace.
And we often hear the term GDP per capita used to assess living standards, don't we? This metric basically standardizes the output by dividing the GDP by the total population. While it's useful, it's really only a snapshot. It doesn't account for things like income inequality, which is a major limitation.
Okay, moving now from how we measure productivity to periods of struggle. We encounter what you could call the contraction spectrum. We start with recession or depression. The source correctly notes this is a period of, national economic failure characterized by poor business conditions and declining employment.
Yeah, a recession is technically defined by most major economies as 2 back-to-back quarters of declining GDP. A depression is simply a far more severe, much more prolonged form of recession. The sheer scale and depth of economic failure during the 1930s Great Depression, that really remains the definitive historical benchmark for measuring modern crises. We look for those key warning signs, that sustained drop in aggregate output and the persistent, widespread rise in unemployment.
But what if the economy manages to avoid a steep crash, but just fails to advance? Then we hit a stagnant economy. This is defined by sluggish growth, where the economy expands very little, or maybe more worryingly, experiences an economic standstill. It could be growing, but below its full potential capacity.
And the consequence of prolonged stagnation is devastating.
Yeah.
High structural unemployment, simply because businesses lack the confidence or the demand signals necessary to expand, invest, or hire. The required remedy.
Yeah.
It's almost always structural reform coupled with targeted stimulus investment. You have to restore faith and demand in the market somehow.
That structural weakness brings us neatly to the extremes of price instability. On one side, the problem of prices consistently falling. Deflation. This is when broad economic contraction leads to a widespread, sustained decrease in the value and price of goods and services.
Right. And on the surface, cheaper prices sound attractive, don't they? But here's the C1 level insight. Deflation is insidious. It creates a negative feedback loop, what economists sometimes call a liquidity trap. Consumers put off purchases because they think, it'll be even cheaper tomorrow. If consumers stop spending, corporate revenue collapses, leading to job cuts, which then reduces demand even further. It's a downward spiral.
And there's a second major danger with deflation, right? Its effect on debt. If prices fall by, say, 5%, the real value of the debt owed by households and businesses actually increases by 5%. That can lead to widespread bankruptcies, which is exactly why central banks have historically fought deflation so aggressively with heavy stimulus. We saw that in the decades-long battle waged by Japan starting in the 1990s.
And the opposite extreme is just catastrophic. Hyperinflation. This is runaway inflation, where prices spiral completely uncontrollably and rapidly, sometimes daily, destroying the value of the currency almost instantaneously.
We have to remember those historical nightmares, like Zimbabwe in the 2000s, where prices doubled sometimes within a day, or even the Weimar Republic back in the 1920s.
That historical context is so crucial. While the immediate cause is often excessive money printing by the government, the underlying economic collapse is really triggered by a complete loss of public confidence in the currency as a store of value. People just give up on it. They revert to barter or start using stable foreign currencies if they can get them.
So we have these extremes. Deflation paralyzing consumption, hyperinflation liquidating savings. What's the stable, desirable state that policymakers are actually aiming for?
That ideal is something called balanced growth. It means the simultaneous coordinated expansion of several key sectors, making sure that progress is synchronized and, ideally, equitable. So this means both agriculture and manufacturing, or maybe technology and traditional industry, are advancing kind of in tandem. It prevents a scenario where one part of the economy overheats, creating asset bubbles, while another part stagnates. It leads to a much more stable, durable, and, equitable expansion overall.
Okay, now that we know how to diagnose the economy, let's explore the complex levers governments and central banks use to manage money and debt. We can start with the central bank's most powerful accelerator pedal, if you like, accommodating monetary policy.
Yes, this is often described as an expansionary stance. It basically involves a central bank actively working to expand the money supply. The goal is to inject life and stimulus into the economy, promoting growth and investment.
So when a recession hits, the classic move is to drastically lower the benchmark interest rates. That makes borrowing money cheaper for banks, businesses, consumers.
Right, exactly. Which increases liquidity and is meant to encourage consumption and investment. But for a C1 audience like you listening, we must understand the other mechanisms too.
Good point. It's not just about rates.
No. Beyond rate cuts, the bank might lower the reserve requirements for commercial banks. That means those banks can then lend out a larger portion of their deposits. And they also engage in massive bond buying programs, often termed quantitative easing, or QE. This injects huge sums of capital directly into the financial system, helping to stabilize long-term rates.
But this tool isn't without some serious risks, is it? The critical view is that prolonged use of accommodating monetary policy, especially those super low rates in QE, risks causing inflation down the line. But maybe even more immediately concerning is the risk of asset bubbles, where all that sustained cheap money causes the price of stocks or real estate to sort of disconnect dangerously from their underlying value.
That's a huge concern. Now, shifting our focus to the government's own finances, we encounter that perpetual fiscal challenge, the budget deficit. Simply put, this is just the negative balance created when a government's total spending exceeds the total income it receives, usually from taxes and fees, over a given fiscal period.
And a persistent budget deficit has immense national implications. It leads directly to the accumulation of national debt, forcing the government to constantly borrow money, usually by issuing treasury bonds, right, to cover the shortfall.
Correct. And furthermore, continuous borrowing can lead to what's known as the crowding out effect, which is a really key C1 insight. When the government floods the market with demand for loanable funds, it tends to drive up interest rates for everyone else. That makes it more expensive for private businesses to borrow and invest, potentially slowing down private sector growth. Sooner or later, corrective measures, like difficult tax reforms or spending cuts, are inevitably required to manage that debt.
Okay, let's pivot to corporate strategy now and how businesses invest in their future. We need to define capital expenditure, or CAPEX. This is the money a company spends on acquiring, maintaining, or upgrading its fixed assets. Things like land, buildings, essential heavy equipment used directly in production.
And for investors, high capex is generally seen as a strong sign of long-term health. It demonstrates that the company is actively expanding, increasing its production capacity. It signals optimism about future demand and revenue growth, which is precisely why market analysts scrutinize these figures so closely.
And related to CAPEX is the accounting method used to write off the value of those assets over time. Companies generally expense the cost of an asset over its useful life through depreciation. But a specific and strategically important method is accelerated depreciation.
Right. This accounting method basically front-loads the depreciation schedule. The asset's value is reduced much more heavily in the early years of its useful life compared to later years. The motivation is kind of twofold. First, it often accurately reflects the real-world value loss of assets that rapidly become obsolete, like high-tech machinery. Second, and crucially, it allows companies to report lower taxable income in the near term. This helps them recover their investment costs faster and generate significant tax benefits.
So if a company is buying something with a short lifespan and a high risk of obsolescence, like maybe computer servers, accelerated depreciation makes a lot of sense. But if they buy a building, they'll typically use straight-line depreciation over many years. And auditors must rigorously review these depreciation schedules, making sure the company's classification of assets is compliant and not just a form of, well, aggressive tax avoidance.
Now, once that debt is incurred, whether it's for CapEx or just operations, it needs to be managed. The process of paying back debt through small, regular payments over time is to amortize it. It's essentially the scheduled liquidation of debt.
The most common example we probably all know is the 30-year residential mortgage. Homeowners amortize that huge principal amount through monthly payments designed to gradually chip away at the outstanding balance. But it's important to remember, amortization also applies to intangible assets. Things like writing off the value of patents or goodwill on a company's accounting books over their expected useful life.
And speaking of immediate obligations, a healthy business requires strong liquidity. This is measured in part by the active balance.
Okay, the active balance. This represents the surplus currency or immediate cash reserves that are circulating regularly between payments. Essentially, it's the working capital surplus needed for covering daily operational expenses smoothly, without having to, liquidate long-term assets or rely on short-term borrowing just to pay the bills.
And here's the crucial insight. A company can be highly solvent, meaning its total assets far exceed its total liabilities, suggesting long-term health. Yet it can still fail because of a lack of liquidity or a low active balance. If the bills come due before the revenue arrives, well, you're in serious trouble, regardless of your balance sheet.
And sometimes that smooth flow of money just freezes up across the entire economy. That leads to a catastrophic credit crunch.
A credit crunch refers to severe economic conditions that drastically reduce the willingness of financial organizations to lend money. Banks just stop lending. This scarcity of credit quickly causes serious economic problems, stalling both investment and consumption almost simultaneously.
The 2008 global financial crisis is the textbook modern example, isn't it? The initial crisis in the housing market and then the subsequent failure of complex financial instruments. It made banks fundamentally distrustful of one another's balance sheets. They started hoarding capital rather than lending it out, resulting in a systemic lending freeze. Central banks were forced to inject hundreds of billions in capital just to try and ease the crunch and stabilize the whole system. All right, let's broaden our scope again now out to the global arena. The world economy is this massive web of connections, investment flows, and really complex regulations. When a nation demonstrates health and stability, it often attracts substantial foreign direct investment, or FDI.
That's right. FDI is the monetary commitment made by foreign organizations or individuals into domestic assets. That could be building new factories, acquiring existing companies, or maybe investing in infrastructure projects. The impact for the host country is hugely important. It brings in capital, technology transfer, and perhaps most visibly, it spurs significant job creation.
And nations compete fiercely to attract FDI, don't they? Often offering policy attractions like tax holidays or simplified regulations. However, governments also have to exercise vigilance. They need to monitor FDI closely for regulatory concerns, especially when investments touch on sensitive sectors, maybe related to national security or critical infrastructure.
And the primary drivers of this global economic integration are often the transnational corporations, or TNCs. These are massive global enterprises involved in international production, managing assets, and executing foreign investments across multiple countries, often simultaneously.
TNCs are really the engine of globalization. They run these incredibly sophisticated, often multi-stage supply chains all over the world, but their global reach also poses unique regulatory challenges, doesn't it? Especially when it comes to taxation.
Absolutely. This is where we introduce the C1 concept of transfer pricing. TNCs have the ability to set the reported price of goods and services exchanged between their various subsidiaries across different borders. This strategic practice allows them to artificially shift profits from high-tax countries to low-tax havens, effectively minimizing their global tax burden. This forces international regulators to constantly try and play catch-up to ensure fair practices.
And these TNCs operate within trade rules, which brings us to that core tension in trade policy, openness versus restriction. The open side is represented by the Free Trade Agreement, or FTA.
An FTA is a formal pact between two or more nations. It's specifically designed to reduce barriers to trade, things like eliminating or substantially lowering tariffs and quotas on imports and exports. NAFTA, which is now the USMCA, was a landmark regional example. The central economic argument is always that FTAs boost cross-border commerce, leading to greater efficiency, lower consumer prices, and ideally mutual gains for the participating economies.
Okay, then on the restrictive side, we have the most common barrier, the tariff. This is a charge or tax levied specifically on goods entering a country. Essentially, it's an import duty.
And the tariff has a deliberate dual role. First, yes, it generates revenue for the importing government. Second, and usually more importantly, it protects vulnerable domestic industries from intense foreign competition by making imported goods more expensive for consumers.
But the crucial insight here is its strategic use, especially today. While tariffs protect domestic industry, the indirect effect is that they usually raise consumer prices at home. So citizens are effectively subsidizing those domestic industries through higher costs. Furthermore, tariffs are now frequently used as political and negotiating leverage in modern trade disputes, not just as simple revenue generators.
And the most extreme trade restriction a nation can impose is the embargo. This is a formal government order to temporarily stop all trading or commercial exchange, and sometimes even informational sharing, with another specific country.
The historical example of the oil embargo in the 1970s really demonstrated how such economic sanctions can drastically disrupt global markets and cause severe shortages worldwide. Lifting these restrictions is rarely a simple economic matter. It typically requires significant diplomatic resolutions and shifts in political policy to address whatever the underlying conflict was.
Now, when nations engage more constructively, they often offer bilateral assistance. This is aid given directly from one government to another, country to country, without going through intermediate international organizations like the UN or World Bank.
Bilateral assistance is inherently strategic, isn't it? It serves to strengthen diplomatic ties, maybe enhance political influence, and provide essential support for development projects abroad. But for advanced analysis, we have to acknowledge the ongoing policy debate.
Whether this bilateral aid, which can often be tied, meaning the recipient has to buy goods from the donor country, is actually less efficient than multilateral aid, which is pooled through organizations like the World Bank and allocated based on need.
And the direct opposite of this whole interdependent global framework is the concept of autarky. This is an extreme economic policy where a nation aims for complete self-reliance and total economic isolation. It tries to maintain a completely closed economy.
Historically, large-scale attempts at autarky, like those seen in certain mid-20th century regimes, have ultimately failed, haven't they? While they might aim for internal stability, they inevitably lead to shortages, massive inefficiencies, and technological stagnation. Why? Because even the largest economies rely on global trade for specialized components, technology, or crucial natural resources.
The reality of modern, highly interdependent supply chains makes genuine autarky exceptionally rare today. It's almost impossible.
Right. So ultimately, most modern nations operate under the principles of a market economy or free market. This is an economic system where the allocation of resources, the setting of prices, and the determination of output are fundamentally driven by the impersonal forces of supply and demand. Competition acts as the primary engine for innovation.
And this relies on that core foundational idea of supply and demand. The price of goods is dictated by the dynamic equilibrium between how much of a product is available, that's supply, versus how much consumers want and can afford to buy, that's demand.
But for a C1 understanding, we need to go deeper than just the definition, right? We need to recognize concepts like elasticity, how sensitive demand is to price changes for different goods.
And understand that a disruption, like a natural disaster or a geopolitical crisis, acts as an external shock. It shifts these supply and demand curves and upsets the entire market equilibrium. Regulating these market economies is also essential, primarily to prevent severe wealth inequality and, crucially, to prevent the formation of monopolies that could undermine the very competition the system relies on.
Okay, we've covered the macro scope and global trade. Now let's zoom right in on the detailed metrics businesses use to measure success, and also how the very nature of economic agency, how people work, is changing in the modern era. First, a key metric for every single investor: earning per share, or EPS.
Yes, EPS. It's simple to calculate but complex in its implications. It is simply a company's total profit divided by its number of outstanding shares of stock. A high EPS ratio is generally seen as a powerful signal of robust company health, strong profitability, and efficient management. It's arguably the single most important metric tracked by potential and current investors when evaluating a stock.
And these earnings, along with all financial tracking, have to adhere to a specific reporting calendar. The financial year, or fiscal year, FY. This is the 12-month period used for managing money, which, importantly, does not always align with the standard January to December calendar year.
That's right. The decision of when the FY starts is often highly strategic. Companies might choose an FY that ends just after their busiest season, for example, allowing them to report maximum performance when they're closing their books. Aligning their reporting, their auditing, and their strategic planning with the FY is absolutely crucial for compliance with tax calendars and various regulatory bodies.
Now, beyond corporate reporting, governments use tools to manage instability in strategic sectors, particularly commodities. A vital tool here is buffer stocks.
Buffer stocks. This is essentially a reserve inventory, a large supply of a critical commodity, maybe grain or strategic minerals like oil, that is deliberately bought up when there's a surplus in the market, when prices are low, and then released for sale when the commodity becomes scarce and prices are high. The essential purpose is market stabilization. It helps prevent dangerous price volatility and can ensure national security of supply for critical goods.
A prime example is the management of national grain reserves for food security. Makes sense. However, managing buffer stocks is actually quite costly. It involves significant storage expenses, spoilage risks, and economists often debate whether this kind of government interference in the market ultimately distorts natural supply signals and leads to inefficiencies.
Another common form of financial intervention is the subsidy. This is basically a direct grant or financial support given by a government to encourage or help a specific economic activity or sector.
We most commonly see agricultural subsidies, right, which support farmers through market fluctuations. Or maybe energy subsidies, which incentivize the adoption of renewable energy technologies by making them cheaper for consumers or producers. The political debate around subsidies is always pretty heated. While they support key social goals, critics argue that they distort true market efficiency and often end up benefiting entrenched industries rather than promoting genuine innovation.
Governments also rely on highly specialized tax measures, such as supplementary taxation. This refers to additional taxes or incremental duties that are levied due to an increase in the official assessed value of an asset. This is often triggered by a change in ownership, like when a property is sold or transferred.
And these valuations are highly scrutinized, I imagine. Accurate budgeting relies on predictable revenue from these taxes, but disputes frequently arise over the methods used for asset valuation. This can often lead to protracted legal challenges between property owners and local authorities who are seeking to maximize that incremental duty.
Finally, we really must analyze the profound shift in the labor market itself. The rise of digital platforms has dramatically accelerated the growth of the freelancer, or gig worker.
Yes, the gig economy. This is defined as someone not employed permanently by a single organization, but who performs specific, often short-term tasks or contracts for many different clients, essentially, an independent contractor. The immediate draw for the worker is often the independence and autonomy. And these digital platforms effortlessly connect these workers with clients globally.
But for macroeconomists, the rise of the gig economy introduces real complexity. It affects traditional unemployment and labor force participation metrics, often obscuring the true state of underemployment people working, but not enough hours or below their skill level. Furthermore, it raises significant policy questions about maintaining the social safety net, as freelancers typically lack traditional worker protections like employer-funded pensions or health insurance contributions.
And this entire system, this new way of working, is underpinned by e-commerce, which is simply the business of buying and selling goods and services online, the digital marketplace.
E-commerce, exemplified by giants like Amazon or Alibaba, has completely revolutionized consumer behavior and logistics. It provides massive scalability and global reach for even the smallest businesses now. However, this entire system relies entirely on sophisticated technical safety measures, things like strong encryption and multi-factor authentication, to protect financial transactions from fraud and, critically, to ensure consumer confidence in the digital system itself.
So to bring our discussion full circle now, we've intentionally examined economic concepts at both extremes of scale, haven't we? We've really been discussing the interplay between macroeconomics and microeconomics.
Exactly. Macroeconomics looks at the big picture, the entire economy, examining aggregate trends like inflation rates, national unemployment levels, overall GDP growth. Microeconomics, conversely, focuses on the small scale, on individual agents and markets, examining consumer behavior, the supply decisions of individual firms, specific market equilibrium curves for one product.
And this is the ultimate takeaway for you, the listener. A truly comprehensive understanding of the economy requires mastering the language of both. Understanding micro-level concepts, like how consumers react to price changes, elasticity, helps you predict aggregate macro trends.
Which raises a really important question, doesn't it? How does the individual decision of a single consumer to maybe delay buying a new car, that's a micro decision, how does that contribute in aggregate to the overall national budget deficit if that consumer ends up needing government support? The ability to connect these two scales, micro and macro, is really what separates novice analysis from genuine C1 level insight. #outro.
Wow, what an expansive deep dive that was through the C1 economic landscape, from the analytical dangers of deflation and the horrors of hyperinflation, all the way to the complexities of foreign direct investment and free trade agreement freedoms. We have armed you with over 30 crucial terms. You really are now equipped to dissect complex economic topics with incredible insight and precision.
Yes, but the critical next step is application. Take these sophisticated terms, maybe accommodating monetary policy or accelerated depreciation, and actively try applying them. Maybe summarize a recent financial news article or an economic report using them. That active process of contextualizing the vocabulary is where linguistic fluency is truly built and solidified.
Absolutely. And as a final provocative thought to leave you with, building on our discussion of trade and isolation, if global supply chains do continue to fragment and geopolitical tensions keep pushing countries towards securing their domestic resources, which of these concepts we discussed, autarky or transnational corporations, will ultimately have the greater long-term influence on global job markets and consumer prices over the next decade? Something profound to consider.
A fascinating dilemma indeed, one for the modern global strategist to grapple with.
Well, if this economic exploration enriched you, please be sure to like, share, and subscribe to this YouTube channel. We'll be back soon with another deep dive.